This is Bloomberg's The Open. I'm Manus Cranny in for Jonathan Ferro. The ECB President Christine Lagarde there, just finishing her press conference in Frankfurt. And perhaps the most prescient line there is as she closes, we're not celebrating, but the disinflation is in progress. The Fed don't have that. They have supercore rising. Markets look like this in the very first flush of the opening bell. Equities managed to regalvanize themselves from a pretty bruising day yesterday, the second worst CPI reaction in U.S. equities that we've seen since 2022. So there is some reprieve. The likes of NVIDIA had actually, ironically, a very good day yesterday, up 2%. So we are just seeing hangout in tech if you want a little bit of a defense there. The producer prices come in on the month a little bit better. We'll get more from Mike McKee on that in just a moment. The Nasdaq up 0.3%. Yes, you saw Microsoft down over 1%, Apple down 1.33%. Roll it over and have a look. There's NVIDIA at the bottom of your screen, up 0.2% at the moment. The euro, in the very first instance, wants to focus on the optimism. They are preparing the groundwork for rate cuts. The dynamics of underlying inflation, the strength of our monetary policy transmission, that's what invoked that drop in the euro. Of course, she made it very clear, Madame Lagarde, is that the Eurozone has a different set of inflation dynamics to that of the United States of America. Roll it forward and let me just show you what's going on in the bond markets. Again, they are not celebrating at the ECB, but the disinflation narrative is in train. This is a small drop in yield. Don't forget, we had a global bond market right yesterday on the back of the CPI in the United States of America. I mean, literally, risk was ravaged and there was a wholesale sacking of risk in the bond market. President Christine Lagarde weighed in on the ECB's latest rate decision.
The dynamics of underlying inflation and the strength of monetary policy transmission were to further increase our confidence that inflation is converging to our target in a sustained manner. It would be appropriate to reduce the current level of monetary policy restriction.
From that news conference, Lizzie Burden joins us from Frankfurt. Lizzie, it sounds as if Madame Lagarde was indeed sticking to trend. They're not celebrating. Disinflation is in progress. It was a much more robust narrative. We're carrying on and still hopeful for June rather than stepping back.
Indeed, Manus, and Christine Lagarde has just walked past me after the press conference. Look, there are a few key questions that we wanted her to answer today. We wanted to know whether there's going to be a rate cut in June. Surprise, surprise, she says it's going to be data dependent. But she did let on that actually there were a few members of the Governing Council who were ready to cut today. The next question, what's the impact of that hot US CPI reading on the ECB's thinking? Surprise, surprise, she told us that the ECB makes up its own mind, but other central banks' policies do feed in through various channels. They can't ignore that, but she was trying to appear unfazed. Third question, what if you cut before the Fed? That leads to euro weakness and that feeds back into inflation. She doesn't want to comment on the exchange rate. She says that they don't target the exchange rate, and she's not going to speculate on other central banks' policy. Again, she says we're data dependent. So this is very much what we expected, both in terms of the decision today and the communications around it. But what has happened, Manus, today is the ECB has laid the foundations for a cut. They've sent the clearest signal yet that because inflation is retreating, they will be able to cut at some stage soon. And crucially, the policy announcement had the change in wording on the outlook for rates to say that if current trends continue, it will be appropriate to ease, but they're not committing to a particular rate path. So we wait for more data, but it seems, even if she doesn't admit it, that divergence is ahead, Manus.
It is, and that policy divergence will be manifest in the transmission mechanism through the currency. That's what Allianz were saying to us this morning. Lizzie, thank you very much. Lizzie Burden at the ECB. Let's have a conversation now with JPMorgan's Priya Misra and Winnie Cisar of CreditSights. Ladies, thank you for being with me. Priya, to you first of all, I had a guest this morning saying the ECB has themselves in a bit of a pickle. But Lagarde was very, very clear there that they're not celebrating. Disinflation is in progress. The ECB, it would sound, is in more of a ready to lock and load and go in June than the Fed. Good morning. Is the ECB in a pickle?
I don't think so. I think they're looking at the fundamentals of the Eurozone, both growth as well as inflation. they're seeing or they have confidence. I think the key question is confidence. The Fed's confidence is probably a little lower after yesterday. But, nothing really changed from the ECB's point of view. And I think it was interesting at the end of the press conference, Lagarde said there are going to be bumps along the way. It is something that they have factored into their forecast. So I think the ECB is saying it doesn't need to be a straight line down, but as long as they have confidence that wages are heading lower, that corporate profits can absorb some of that, they can start the process. I think the key question is, they can start the process. The pace of rate cuts will obviously be data dependent, but I think they're telling us they have enough confidence to start the process. So I don't think that they're in much of a pickle here.
Winnie, good morning to you. Good to see you. It's very interesting. You're right, Priya, using the word bumps. In other words, our models are ready for bumps. I don't know whether it was a little bit of a jibe at the Fed. Perhaps they're not just as prepared for bumps in the road. But Winnie, from the European perspective, it does look and sound like, unless there are material bumps, that they will go earlier, and they pretty much need earlier and bigger size cuts than the Fed.
Yeah, it seems that after today's press conference, the ECB is poised and ready to begin to move towards a more loose monetary policy, or at least one that is creeping closer toward neutral, which we don't necessarily disagree with. Now, we still have some hope that the Fed is also going to be able to go in June. We think some of the headline data have made things appear much stronger than the kind of underlying fundamentals would actually indicate. So we're holding out hope still for a more coordinated policy easing cycle across the ECB and the Fed.
Well, the euro now coming back to 107.40. Priya, I just want to quickly tuck this away before we talk to Mike about the PPI. You are still a buyer of this spread. You're a believer in the transatlantic spread in bonds to Treasury.
We are. I think, the fundamentals of the Eurozone, of ECB policy sort of tells us that it's going to be harder for bonds to sell off much. Treasuries, on the other hand, I mean, after that CPI report, the data is mixed. And we still have this fiscal issue. So I think if you were to buy duration, Europe's a better place to buy duration. But I'm getting closer to thinking about buying some US duration as well, probably closer to 460, 475 on the 10-year.
We probably need another little bit of a drive-by in the bond market before we get there and get you in. Ladies, stay with us. Let's just reflect on some of the data we've had this morning on the PPI. Mike is with me in the studio. So it wasn't as brutal in the PPI as it was in the CPI, but to what extent do I extrapolate the PPI to PCE?
Well, you can extrapolate it because a lot of the PPI goes into the PCE numbers. And of course, we're talking about two different measures of inflation, PCE being what the Fed follows, PPI producer prices here. And the theme today seems to be that it wasn't any worse than we saw yesterday, so we can celebrate a little bit. We saw the month-over-month figures come in better than expected, up 0.2% for the core and the headline. Year-over-year, base effects come into play, and so we did see an increase in the year-over-year numbers. But as long as those month-over-month numbers are showing progress, the Fed will be relatively happy. And we can show you the situation with the various inflation indicators. I've got CPI, PCE, and PPI there, and you can see how they all used to track, but now they have diverged coming out of the pandemic. And that makes life a lot more difficult for the Fed to draw conclusions about what's going to happen, because what you're looking at is a PPI that has been much more elevated and a CPI that is drawing closer to PPI. And this is normalization. This is the relationship between them, not the actual levels of inflation. But the PCE has remained well below both of those. So the problem the Fed has is that the markets and the public are looking at CPI, and it is PCE that will drive the Fed. So there may be some disassociation involved in what we hear from Fed officials going forward. Now, the other thing that came up this morning is markets have really priced divergence in terms of various central banks. We're still looking at one rate cut from the Fed by the end of this year. The Bank of England, 2 rate cuts, and we had a Bank of England member say today that was crazy, and then 3 now for the ECB. All this will play with currencies, and of course, Christine Lagarde did not talk about that, but all of this will matter down the road as these central banks try to figure out what they're going to do and the knock-on impact. So it's going to be very interesting going forward to see what data we get, how inflation performs, if it turns around in Europe as it has in the United States, if it maintains that in the United States. But for today, looks like markets are happy because it wasn't worse.
Indeed, a little bit of relief. Priya Misra and Winnie Cisar are my guests. So here we are. Yesterday we saw a wholesale vortex in the bond market because suddenly the door was slamming closed to a June rate cut. There was talk even maybe of no rate cuts. Winnie, you believe that the data does not preclude the Fed from cutting in June. So therefore, are you expecting some kind of massive turnaround in core CPI?
Well, what we're expecting is a continued normalization. When we look at the components of core CPI that overshot expectations, we still have shelter and then transportation services really leading the charge. And I guess thinking back to whether those are going to be reoccurrent drivers of sticky inflation, we don't think that they're going to be. And if anything, the transportation services, which is largely motor vehicle insurance, acts as another tax on consumers, which is particularly tricky when you also have elevated oil prices. And so we do think that there will be continued normalization on the inflation side of things. And we haven't been expecting just this straight line back to 2% on core. And we think that the Fed does have some latitude to start to move just towards a very less restrictive, not necessarily accommodative or even neutral monetary policy over the coming months.
Priya, the talk in the market is now non-negligible risk of 0 cuts 2024. Of course, we overreach. That's what markets do. They overreach. They become too exuberant on the bid or the offer. How real is that risk, and how real at all is the tail risk of a rate hike? And what would that do to the bond market?
So I think if you listen to Fed officials, there's really nobody talking about rate hikes.
Just
but
Larry
I do
Summers.
get concerned. I do get concerned that if the market starts to price in absolutely no rate cuts this year, then you should put in a probability that they might hike. So I think that's why it's important. Where do they cut in June, July, September? Actually, it doesn't matter all that much. Do they cut at all? I think that's the question. One of the things I'm also keeping a very close watch on is wages. We know service inflation is sticky. We know service inflation is extremely linked to wage inflation. Despite these very strong payroll reports, we've had wages actually continue to moderate. The supply side of the labor market is helping equalize the fact that you've had these 250,000 payrolls and yet wages are moderating. If wages continue to moderate, and we're seeing 0.3, 0.4 month over month, I think, and I would say inflation expectations remain anchored, which have been remarkably anchored, I think the Fed can still guide towards rate cuts. Maybe it's 2 instead of 3 or 1 instead of 2. I think that actually matters less. If you do start to see the Fed starting to talk about no cuts, then I think the entire soft landing narrative is at stake. So, I think we always struggle with the economic outlook or the reaction function. I think the economic outlook is giving us a mixed picture. Mike talked about it. Winnie talked about it. You look at the details. Parts of it are heading lower. Parts seem bumpy. Okay. But let's now see the reaction function. So far, I think the Fed's saying we're at restrictive territory. Let's start the process of normalization. As long as they continue to say that, I think we'll price in 1 or 2 cuts this year or 1 cut this year. And I think then the soft landing thesis can persist.
Well, that supercore needs to really, really roll over. My favorite line of the day is from RBC. The rickety dam holding back the no landing narrative may be at stake. So we'll convene again in a month's time and do it all over again with a little bit more data and insight. Priya Misra, Winnie Cisar, my guest this morning on the ECB and the bond markets. Coming up, tensions heat up in the Middle East. Oil prices jumping nearly 20% in 2024. That conversation next with Will Kennedy on Bloomberg.
We also want to address the Iranian threat. to launch they're threatening to launch a significant attack on Israel. As I've told Prime Minister Netanyahu, our commitment to Israel's security against these threats from Iran and its proxies is ironclad. Let me say it again, ironclad. We're going to do all we can to protect Israel's security.
Oil is swinging near the $90 mark. That's after a pretty tough couple of sessions. We're preparing for a whole host of functions. Traders are watching as the U.S. warns of a major attack on Israel by Iran or its proxies. Global tensions have driven the oil market up 18% this year. Will Kennedy joins me now. Well, the market has rolled down since you and I caught up this morning. We don't know what the response mechanism will be from Iran. Is that, along with a tight market, driving this market? How comfortable is OPEC with these prices? Good morning.
Hi, Manus. Thanks for having me on again. I think the market is characterized exactly like you say, by tight fundamental supply and demand, a strong economy, especially in the US, which is driving demand higher, combined with some tight control of the market from OPEC and some other supply disruptions around the world. And on top of that, you've got a layer of political risk. And that's really what's driven this rally, which, you know, if we think back to the beginning of the year, very few people in the market foresaw. There was a real bearish mood in the market, but we've seen, as you say, a significant rally. So it's that combination of the two. What happens from here, you know, there will be a lot of concern from traders that this situation between Iran and Israel, while it isn't currently a threat to any production, and the war in Gaza hasn't taken any production out of the market, although it has disrupted shipping in the Red Sea, is that it escalates to a point where Iran gets drawn into a regional conflict and there is some impact on oil exports from the Gulf region. But I would stress that that's a long way off, but it's a risk that the market does need to be aware of.
Indeed, and as you and I said this morning, the reaction function from OPEC Plus in June will be all the more pressure. And indeed, they all have the capacity, not all, but certainly Saudi and the Emiratis, along with a number of others, have the capacity to add back pretty quickly. Well, thank you very much for joining me this morning. That is Will Kennedy on the oil market. Price action going on in these markets. Katie Greifeld is on set. Katie, what have we got?
Well, it's a pretty even split if you take a look at the sector level right now. You have 5 sectors in the green, 6 in the red. Leading the way to the upside, you have communication services and tech, of course, up about 0.6% a piece. You take a look at what's not doing too well. You have energy, you have healthcare, and then you have real estate. Real estate down by about 0.2%. Financials leading the way, rather, to the downside. But let's talk about real estate, because this is part of a trend here. Real estate is your worst performing sector on the week, as you can see right there, over the past 4 days, off by more than 2%. Of course, really interesting moves in the bond market as well. Perhaps that's working its way into the real estate sector, Manus.
Katie, thank you very much. Coming up, the market moving events to set your clock by, the trading diary on the way. We've managed to put a little bit of calm into these markets. Nasdaq rebounded by 0.4%. Again, day two, Nvidia, even though the equity markets took pressure and a sell down yesterday, Nvidia was up nearly 2%, continues to rise this morning on the back of Bank of America reaffirming their call on that. Russell 2000 up by 0.2%. The PPI just wasn't as brutal as the market had anticipated. Look, we're going to continue with Fed speak today. Barkin, Collins and Bostic all delivering remarks. We count down to the earnings for JPMorgan, Wells Fargo and Citi tomorrow. On Monday, it's Goldman Sachs. They will deliver their numbers. The fresh economic data, including the retail sales, hits the tape. Finally, Tuesday, it is more bank earnings. Bank of America, Morgan Stanley. That was Countdown to the Open, right here on Bloomberg. Good morning.